As I record this in May of 2025, it appears a recession in the United States has already started, and a wider recession on a global scale is nearly inevitable. It's not due to market fundamentals, it's due to US government policy. It should be obvious that it didn't have to be this way, but the exogenous shocks caused by uncertainty and chaos of ever changing tariff policies have ground the global economy to a snail's pace. It appears supply chains can just as easily be disrupted by geopolitical uncertainty as they can be by a global pandemic. This turn of events poses a reasonable challenge to the efficient market hypothesis. This is a hypothesis that states that share prices reflect all available information and that consistent alpha generation is impossible. Accordingly, stocks always trade at their fair value, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Therefore, it should be impossible to reliably outperform the overall market through stock selection or market timing. The only way an investor can obtain higher returns is by purchasing riskier investments. I want to be clear about what portion of the hypothesis is being threatened here. There's nothing associated with the tariffs that suggests stock picking works. That part of the hypothesis remains intact. The part that's under threat is the notion that prices reflect all available information. The United States gross domestic product shrank in the first quarter of 2025, and virtually all economists now expect it to shrink in the second quarter as well. That means we've already entered into a recession in the US. In fairness, and as most people know, the economy and the stock market are not the same thing. However, the performance of stocks depends largely on the health of the larger economy. Given the extreme consensus that the news is bad and getting worse about the economy, it seems fantastic to me that we still haven't seen a major drop in share prices. This lack of a market response calls into question the real efficiency of capital markets. Markets didn't respond in a meaningful way at the beginning of the Trump mandate because there were offsetting expectations regarding efficiency and tax cuts and deregulation that might be stimulative and able to offset the troubles caused by high and wide-ranging tariffs. We now know that the stimulative benefits are not going to be as large as previously expected, and that the tariffs have proven to be larger than anybody reasonably expected before they were announced. Given that the tariffs of April 2nd are now entrenched and well understood, we're left to wonder why the efficient market has not yet responded. We were all given new information a couple of months ago, and yet the market, which is supposed to reflect new information fairly accurately and almost instantaneously, has still not reacted in a meaningful way. The proponents of the efficient market hypothesis say that none of us is smarter than all of us. For over 2 decades, that was what I thought too. I'm not prepared to say that I or anyone else is smarter than the market consensus, but I am prepared to say that the lack of market response to new evidence, which isn't even all that new anymore, has caused me to question just how efficient the market really is.